Hey, good afternoon, everyone. So everyone has probably heard now Silicon Valley Bank or Signature Bank or any of the other banks out there that has been head of the news the past few days. So I'm here today to go over what happened and what does this mean for mortgage interest rates. So Silicon Valley Bank last week actually collapsed or shut down. The federal government had to take control over it, along with Signature Bank this past weekend and possibly even future banks here in the near future. So what happened and why did this happen? So on Wednesday last week, customers tried to withdraw $42 billion in assets from Silicon Valley Bank. Silicon Valley Bank did not have those assets to give to the customers. Why? Well, Silicon Valley Bank took the assets, the customer deposits, and put that money in U.S. Treasury bonds. So let's go into why they do this and why they didn't have enough money to cover these deposits. So originally you put this money in a bond so that you can earn a premium. Last year, that premium was paying around 2%. So if you put $1 billion, you're going to earn 2% over the course of 10 years, paying that back. So what happened is obviously interest rates have increased massively over the course of the past year. So now that same US 10-year bond is paying anywhere between 3% and 4%. So for those who bought that bond last year paying 2%, and people can buy the bonds now at 3 or 4%, that 2% bond is essentially worthless. Or now it's basically at a much discounted price because no one wants to own anything when it only pays 2 when you can get it at 3 or 4%. So again, what happened is customers tried to withdraw $42 billion in assets. Silicon Valley Bank didn't have it. So Silicon Valley had to liquidate all of these bonds. But in doing so, they had to liquidate all of these bonds at a massive discount because no one wanted these bonds anymore. In doing so, they realized significant amount of losses. And because of these losses, they were not able to cover basically those $42 billion in deposits. So again, what does this mean for mortgage interest rates? Well, the government had to step in and the government had to back all these deposits to allow confidence in our banking system. So interest rates have now come down significantly over the course of the past 24 to 48 hours with a lot more information still to come. So they could obviously go back up or they could come down even further. We don't know. But the reason why interest rates came down is the federal funds rate. The federal funds rate is what the government dictates interest rates for short-term interest rates. That was previously projected to go all the way up to 5.75% in July of this year. But with the uncertainty, with the risk, with the doubt in the market now, the Fed is now in a pivotal position. Do they continue to increase interest rates or do they not continue to increase interest rates to allow the market to kind of breathe a little? So the futures market is only projecting the federal funds rate to go to 5% instead of 5.75. And year-end interest rates are projected to be at 4.25%, whereas year-end was projected to be at 5.25%. So massive difference between where we were at Monday last week to where we are now. Again, a lot more information still to come. We don't really know exactly how this is going to play out. We don't know what this is going to do to the U.S. taxpayer. We don't know how this is going to hurt inflation. Again, the reason why our interest rates have gone up so significantly is inflation. Well, now we're going to need to be printing a lot of money. By printing a lot of money, that increases inflation again, which is the problem that we're continuing to go into this cycle. So again, CPI report is tomorrow. The PPI report is Wednesday, so a lot more information to come, which could change, which means interest rates could be volatile over the course of the next few days. But if anyone has any questions, go ahead and feel free to reach out to a Secure Choice Lending team member today. Thanks, bye.